Welcome, everybody, to the Real Dealz Podcast, one of the top-ranked real estate investing podcasts for the last 7 years. This is the place to be for investing strategies you can actually use, expert interviews, and, of course, some good old-fashioned entertainment. Now, here's your host for the show, Elliot, the REI guy, Smith.
What's going on, Real Dealz podcast listeners? This is show 393. Hope you're having a good week. It's the week before Thanksgiving, so it's weird. My lead flow has been actually really good this week, so hopefully you're seeing the same thing out in your market. Generally, this time of year, it tends to slow down, but the leads that we do get tend to be really good leads, and we tend to buy really good deals in the November, December holiday. So what's going on with us this week? We sent out a bunch of direct mail last week. Lead flow was really good. Have some good leads that came from it. Made an offer on one single family and have about, I think, 4 multifamily deals that we're looking at through there. Not all of them are going to pan out, but we have opportunities to go look at, so that's pretty exciting. This week, we signed on our 32 unit that we are closing on for Tuesday the 23rd, I believe, right before Thanksgiving. And we took a trip down to, my partner and I took a day trip down to Scottsdale to go meet with some guys to find financing, not really find financing, but talk about financing and figuring out how we fund these deals moving forward. So we're going to talk about that today. So also we ended up hiring a maintenance supervisor, and he started on Monday, so really excited about that. We went out last week. I put a whole list together. I went and spent about $5,000 at Lowe's buying him all new tools, everything that he would need, tons of DeWalt stuff. It was like a contractor's dream. Put it into our 5x10 trailer and then dropped it off at his house. So very excited about that. I think he was very appreciative. You know, we want, in this environment of finding contractors are good employees, especially handymen, it is very important in my mind to give them the best tools to do their job and do a good job. So we're getting everything figured out. We also made an offer on a new lease for some office space, so we should be getting that, I think. So we're going to be moving offices with, we're going to stick with sharing an office with a couple of my buddies, but it's going to be more professional. They're going to just have the 3 owners in there, and then us and my team will be in there as well. So we'll build out a brand new podcast room there as well. We'll basically take all the equipment that we have here, and then we'll build it out over there. So other than that, that's kind of what's going on with me. It's going to be a little bit shorter show today, but just wanted to talk about some things that I've been learning as I've been going on financing multifamily, and it's applicable to not just multifamily financing, but also single family rentals and fix and flip financing as well. So quick word from the sponsor, and we will get into it.
All right, Real Dealz podcast listeners, I want to talk quickly about our show's sponsor, Ironbridge Lending. If you guys have not reached out to Ironbridge already to talk to them about funding some of your upcoming flip projects, I highly encourage you to do so. I've known the owner of Ironbridge for a very long time. I've personally borrowed millions of dollars from them over the years to do a number of different projects, and I can say without a doubt, they are the best hard money lending company I have ever come across, and that is the reason why they are the sole sponsor of this show. I've had a lot of other companies reach out to me and want to sponsor this show, but I just won't do it. I feel like I need to be genuine in who we have sponsoring the show, and it needs to be somebody that I've personally done a ton of business with. So I personally vouch for their ability to be the best, hands down, in the world of hard money lending. You won't find better programs, you won't find better terms, and they're lending or will be lending in over 20 states. So chances are, if you're hearing this in whatever state you're in, it's definitely worth it to check out their website, reach out to them, see if they're lending in your state, and if they are, I would absolutely encourage you to do business with them. Another very cool thing to note is that they have a program for most rehabs where you can actually borrow up to 90% of the purchase price. Now, this is given the fact that you are actually buying a deal, which if you're listening to the show, that means you probably are. But if you have an actual deal on the table, they'll fund up to 90% of your purchase price, and they'll even give you rehab funds on top of that, which means that it only takes 10% down to get into a project, which is unbelievable in the hard money world. So Do yourself a favor, reach out to Iron Bridge Lending, have a conversation with them, see if they're a good fit for you and for your next project. I can guarantee you that you'll be happy that you did.
All right, so we are going to talk about what I've been learning on financing. So as we've been going in this multifamily space, we've trying to figure out how do we finance them to scale. We bought the 24 unit last year, and when we bought that, we had like 2 weeks to close. So we basically had to go, we were buying it for 1,685. We ended up getting a private lender for 800,000, and the 4 partners all put in roughly 200,000 each. So we got, whatever. Some guys put a few more bucks in, whatever. Everybody put in what they could, and we financed it. And then 45 days later, we refied that to get the private lender out, and everybody ended up leaving like $125,000 into that deal. So $125,000 locked away, what we had. And then when we bought the 8 unit next, I did that deal. We were buying it for $1,030,000. And I did not have the $300,000 to go ahead and put it down. So at that time, I had a cousin that had just refied a property, so he had about $100,000. He lived in the area and had a rental right by where this 8 unit was. And I had a private lender that lived in California, and he wanted to get some money in play. So when we structured that deal, we basically split up equity 3 ways, so a third, a third, a third. But when I went and raised the equity capital, it was different. So my investor from California actually put in the most cash at like 140. But what he was really looking for was a 5 to 6% annualized return, cash on cash return with upside. So when we penciled the deal, I worked him into about a 6% cash on cash return for where we were at in the deal at that time with what we thought it would cash flow and all of that. And so he came in and brought in more money because he didn't really do it. He didn't find the deal, and he wasn't going to manage the deal. But my cousin, on the other hand, he was in the area by the property, so he was going to manage the deal. He was going to manage the tenants and do more of the day-to-day stuff since we did not live there and we didn't want to do it. So he's doing lease-ups, he's doing tenant turnover, things like that. He's not doing any major maintenance or CapEx projects. So he came in with roughly 90,000. And but his deal was he's to earn more of his cash on cash and equity. He was going to be managing the deal, and we would help him along the way. Since we found the deal and we were going to help with a little bit of the paperwork on the management, we were able to come in with I think 90, right at 90 as well. So it was actually ended up being a little bit more at the end of the day. At the end of the day, but that was roughly what it was. So we were assigning value, equal equity, but the amount of equity coming in was assigned based on the value they brought to the deal. Money is important, but it's not the most important thing. When Greg and I bought the 25 unit in May this year, we went straight to Freddie Mac. Which is called more of actual debt, like national institutional debt. So we went to Berkadia and got a loan from them. We were buying the property for $2.1 million, and we needed roughly 600 and some thousand. They wanted 95,000 for COVID reserves, so we ended up having to come up with like 650, but only like 560 of that was our our payments and our money coming in. On that deal, we just wanted to go 50-50. We had the money. Greg had the money. We both put in the down payment, and that money is locked away. Now, since I had found the deal, and it was the first deal that we had done with Greg, I brought it. We actually got to bring in 45% of the money. Greg brought in 55% of the money because he assigned a value for us bringing the deal to the table. And then the property management, we get paid for property management. Our overhead gets covered for that deal, and his team does help. So the problem with that is now Greg and I have locked away $600,000. We can pull it out and do a refi because now that property is probably worth 3.3. So we have roughly $1.2 million in equity minus selling costs and things like that. But if we wanted to go refi it, we have a prepayment penalty with Freddie Mac. So when we got that debt, it was a 30-year amortization We had a 10-year term, so that means the rate is locked in for 10 years at 3.9%. And 2 years of that was interest only. So for the first 2 years, we only had to make interest only payments. So our payments were quite a bit less. So if our loan is roughly $1.5 million, do 3.9% of that, and that's our our yearly payment. So what the hindrance on that is, to prepay it, we have a prepayment penalty. They do two things. They do either yield maintenance or they do like a waterfall. So we did the waterfall. So it's 5% year 1, 5% year 2 if we want to pay it off early, 4% year 3, 4% year 4, 3%, 3%, 2%, 2%, 1%, and 1%. So that means is I basically, of that $1.5 million loan, if I want to refi right now to pull my cash out, then I would have to pay 5% of the loan amount to pay that debt off early. So that's like $75,000. Now, if I can make more than $75,000 plus some, then it makes sense, but it's something you really don't want to do. So then we tied up this Goethals property in Richland that we're closing on Tuesday. Now, this is where it gets interesting when we start learning where to go, because I'm not sitting on a huge stack of cash. Nobody ever has infinite cash, right? You start getting really good deal flow and you start doing really good deals, but then all of a sudden you eventually run out of money to do these deals. Now, we have private lenders for all my single family fix and flips. I've never had problem getting money from lenders. But right now we're needing 7 figures of capital to bring into these deals. So we just ended up on this deal putting $1,075,000 in on this deal. So what we did here when we were doing this is we started to structure the deal where we were going to get the seller to carry back, one of the sellers to carry back a personal note, personally guaranteed by us, $500,000 at 8%. She was on board up until like 2 weeks ago, but she was on board. So that was the first thing we're going. You're in these bigger deals. Some of your best lenders are the people that are getting a ton of cash back. They don't know where to put the money. So then we also had another lender that was giving us a personal note in that same range price point at 6.5%. So that one's still good. But now the seller backed out, and so we ended up having to go in, and now we're gonna have to fund that ourselves. But now I have another deal that we have a verbal on that we're gonna need about $1.5 million. Again, money runs out. So how do we do this? How do we start raising this capital where we can continue to scale? Because we don't want to sell these properties. We don't want to keep selling them. We were selling one, but that's with 4 partners, and I'm only going to get, a couple $100,000 off that deal, plus some money back. So it's just not enough. So we had some talks today with so we went to Arizona and we talked to some guys. One guy was worth roughly $500 million. They own 46,000 units. They're like the 7th largest private debt fund in the country. Raised $2.5 billion on their last fundraising round. So this guy was a shark. This is what they do for a living. So they were saying everybody's going to want on these deals that if you raise more capital, people are going to want equity. And so that makes sense. If you haven't heard, there's what people call as syndication. Syndicating deals is where you go put a deal together, you syndicate all the investors. If you follow Brandon Turner, he does this a lot. But they have a general partnership, which would be me, the deal sponsor, the guy doing the deal. And then they would have limited partnership, which would be just the people that are bringing cash in. And a lot of times those deals are structured 50-50, LP-GP, or 70-30, limited partner GP, and then GP getting 30%. That's typically how bigger deals are done. And then the really big deals are more 80-20. So 80% to the limited partners and 20% to the general partners. So we don't want to do that because those guys on those big deals, they can do those deals because they're so big. They're doing 20, 30, 40, $100 million deals. And not only does that 20% of a $100 million deal look really good on the general partnership side, but they also take fees along the way. So typically on these syndication deals, they're taking a 2 to 3% acquisitions fee. They're taking a construction management fee. They're taking an asset management fee, which is different than property management. They're taking a property management fee. They're taking a dispositions fee when they sell the property. They're taking all these fees. And on those big deals, they're making 7 figures just on the fees. So they make you make money up front, you make money through the deal, then you make money when you sell, and then you also get 20% of the deal when it goes. Now you do have to pay throughout when you sell the deal. You have to pay, because a lot of times you're doing a preferred return. So you're saying, I will give you, before I take any money out of this deal other than my fees, but before I take any of the profit and upside out of this deal, I will make sure that you get what your preferred return is. 6, 7, 8% is usually what that preferred return is. And then after that, we split it however it is, 70-30, 80-20, 50-50. So on these smaller deals that we're buying for $3 million, it doesn't make sense to do that because there's not enough money in the fees because the deal's not big enough. And not only that, is we are not going to be incentivized if we're giving 50% of this deal away or 75% of this deal away, because it just doesn't move the needle for us in any meaningful way. So we are trying to figure out, how do we get deals like this done? So it's not easy, and I still don't know if I have it all figured out, but there's a couple of things that you can do. You can go get personal debt on these deals. So I can just go get a personal loan. So I can go say, hey, Mr. Investor, you know me, you trust me. I'm going to personally guarantee I need $1 million at personal debt at 8%, 9%, 10%, whatever. And it's not tied to any property, but I will personally guarantee this. I'll back all my assets that I have and my net worth, that if I default on paying you, then I have to liquidate some of my assets to pay you back, which I have a good amount of assets. This is why it's nice to have, when you have single families or smaller rentals, keep not always refining and pulling all the cash out of them, because you can still leverage them in other ways. So, I can say, hey, my portfolio is 50% LTV on pretty much all my properties. Then I have some money that they say, okay, worst case, if he doesn't pay me back and lose my money, I can go after these properties. So you have to have some of that. You have to have something backing up your willingness to personal guarantee. Because if you have 0 properties, 0 money, and 0 equity anywhere, personal guarantee doesn't mean shit, right? So that's one way. And then another way we found out was you can do what's called preferred equity. So that preferred equity is basically when I'm going to give them a preferred return on their money, call it 8, 10, 12%. But it's a preferred equity, so it's called pref equity. So it's basically they have equity in the deal, but they don't have equity in the upside. So once they get their 8, 10, 12%, I get everything else after that. So then there's mezzanine debt and things like that. So very interesting how this world works. And this, I was talking to Artem, who's been on the show before today, and this is why people go to bigger deals really a lot faster, because we're stuck in this middle deal where we need a decent chunk of cash. It's not just where I can go get it from my, my normal private lenders. So we need a bigger chunk of cash, but we don't want to give a bunch of equity in the deal away, so it's not big enough to take fees along the way. So it's a very interesting thought. So if you're interested in these things, and this isn't a pitch by any means, Brandon Turner did just write a couple books on multifamily. There's book 1 and book 2, and they do talk about some of this stuff. Now, I don't think they get into the weeds as much on like these things. So I really wanted to just talk about what I am kind of learning and trying to figure out myself, because that's what I want this show to be, is somebody that can grow with me. And so if you have any feedback and if you've done any of these deals, I'd love to hear what you have to say or how you structure this type of debt. So that's really, really what's going on right now. Now, the big issue is when we have this other verbal on this other property, we have to potentially, we haven't inked it yet. We had told them that we would close by the end of the year, and this was 2 weeks ago. I'm hoping that we don't have to, but if we have to close by the end of the year, we're not going to get our normal bank bridge loan debt in time because there's not enough appraisers, or the appraisers are so backed up. So if we have to do that, we have to figure out how to come up with $3.5 million and to take this deal down for a short period of time. Let's call it 1 or 2 months. And then at that point, we can, get bank debt on the property, but we still probably need $1.5 million in this deal because we're going to put $1.3 million rehab. So where do we go get that money? And then how do you fund your operations? Because if you're putting your money in these things, you're getting cash flow, but as you're turning these properties over, you're not getting a ton of cash flow because if you're doing a lot of units at a time, you don't have the cash flow or the rents to then cover your management and operations. So it's a challenge, and it's really fun, and it's a challenging game of chicken or the egg. And how do we get these deals done without giving up a ton of equity? Now, if we wanted to go raise and give half the deal away for money, you could raise that all day long. I mean, literally all day long I could get that money, but I don't want to do it because we want to just pay somebody 8 or 10%. And at that point in time, then they can, they just get a preferred return, all yada, yada, yada. But then they're not getting any of the upside in the property because we want to hold these for the long term. We only want to use the lenders for the short term because once we go refi it, the idea would be that we can refi out all our cash or investor equity, pay them off. Maybe if we had to leave some money in the deal, we can leave a couple $100,000 in the deal ourselves, no big deal. But then we can pay them off and then they're done at that point, and then I can roll their money into a different deal. So that's what we've been doing. I've been talking to a lot of people about raising capital this week, and that's really kind of the thought process. So if you have any feedback or you've done these things, I'd love to hear from you. Reach out to me on Instagram, Elliott Smith, REI, on Instagram, and let me know how you've done it. And I will keep you guys updated throughout on these deals that we're doing and how we're financing them, because that's the hardest thing. If you've been listening to this show for a long time, you're probably finding good deals. So as you move upstream, if you want to move upstream or want to do more deals, even on the single family side, you have to find better ways to get debt because you really want to get out of that hard money space. And just for an example, we were looking at the $3.2 million deal. We can go to like a Civic or more of an institutional finance, kind of like a hard money company. So they're going to be more expensive than your local bank that we're getting debt for, the bridge debt from. But so we looked at them. They're 1 to 2 points, but they're 8% interest. Now we got this last loan 3.75% interest. Well, the difference in a single family house, if you're sub 400,000 and 4%, really doesn't matter a whole lot. But on a $3 million loan, that's $120,000 a year on just the 4% interest difference. So if you're holding that deal for 2 years, that's $240,000 that you're paying additional than if I just got the bank debt on that money. So it adds up really, really quick. And so you have to be, what I'm finding out is you have to really have your money lined up and have some good ideas on how to finance these things, because that's really what makes or breaks these types of deals. So anyway, hope you guys have found some value out of this today, and I will catch you next week.